Welcome to LaTour Retirement Talk. I'm your co-host, Tony Shore, and I am excited today because I am here once again with Jim Margraf and Josh LaTour. Love you guys. We have a great time on the show together. We were having some fun off air before the show started, some laughs. We always save outtakes and bloopers. Sometimes we share with the listeners. Sometimes we don't. If I want to embarrass Jim and Josh, of course, half the bloopers are me as well. So there's that. Well, hey guys, how have you been? Josh, let's start with you. What's going on with you?
Oh, Tony, I've been good. Other than the fact, here we are, we're recording this in the middle of May, and it seems that the trees and the flowers have decided to personally attack me. And it's personal this time.
Allergies. Yeah. Allergies. Yep.
But apart from that, I've been very good.
You looks like you picked the wrong week to stop taking your allergy medication. That's what they say. How about you, Jim?
I've been very good, Tony. Very busy. Had a little bit of something unusual for me. I was asked to be the commencement speaker for a graduation this weekend. So
really?
Yes.
That's awesome. So, well, you're a radio show host. You're a financial guru. So it makes sense. A great public speaker. You've done seminars and things and workshops. Why not? How did that go? Did you already do it or is it coming up?
It's already done. And
how did hours later, no.
Well, I had some people tell me it went very well.
That was good.
It didn't feel like it to me at the time, but perception of yourself isn't always the best barometer of how you're doing.
Nope, it isn't.
So it's the second time I've done that. The first time was at my son's graduation.
Oh wow!
So it was for some kids that were homeschooled. Through our church and everything. So they asked me to be the speaker. And
right.
That was
it.
That was an experience.
So it was a high school graduation?
Yes.
Mm-hmm. That's nice. And Josh, you were there?
I was there, yeah.
So you saw him. Did it go long or was he long-winded or how did he do it?
No, honestly, I think what were you like maybe 15 minutes?
20, something like that.
Yeah, something like that. Yeah, it was good.
Not bad. And I assume, like, if I have not been asked, I'm kind of bummed out that I haven't been asked to speak at a commencement address. I think they're worried about what I might say. But what life lessons is he going to give the kids? But I assume, Jim, that you ended with always wear sunscreen. And remember, always wear sunscreen.
No, I did not.
I would either end with that or I would say, remember, wherever you go, there you are. Yep. In the words of St. Thomas Aquinas, we'd really appreciate it. I like to say that one too. So today, to get into the finance, you guys have a serious topic. I shouldn't be joking around. We should jump into it because we're talking about withdrawals from our retirement accounts. And this is a big deal because this is something, if people get it wrong, it can lead to costly mistakes and errors or derail your retirement. So today we're talking about what people out there need to know about withdrawals from their IRAs, their 401ks, these retirement accounts, especially traditional accounts like a traditional 401k and IRA. So where do you want to begin?
Well, Tony, I want to begin with, I think it'd be good to begin with the fact that you kind of said it. If we make a mistake with these, it's going to cost us a lot in taxes. And one of the things that we do to help ourselves be able to help our clients do this correctly is we go to the country's foremost IRA expert. His name is Ed Slott and Company. And he's got a team of experts, legal experts that go through the law and they pick it apart. Let me tell you, do they ever pick it apart? So like earlier this year, we got a 400-page manual and went through that. And then a few weeks back, we got about another 250-page manual of updates. And this is all just to do with the rules. And also what is in there is, some of the creative ways people have gotten them wrong.
Right.
And that is actually very helpful to see what not to do when it comes to how to take money and how to treat your IRAs and your 401ks, because you do things just a little bit wrong. You think, oh, this is within the rules, and you forgot another rule over here, and all of a sudden this large withdrawal is 100% taxable, or what you thought was a rollover is suddenly 100% taxable,
Right.
and it can be a disaster. And so paying attention to what you do and how you do it with IRAs and 401ks really is important.
Yeah, it's great to learn from your mistakes. It's even better to learn from somebody else's mistakes.
Yes.
And so that's what we want to do. And a big part of what they cover in the EdSlot
Yes.
program is they go through these, they're called PLRs, private letter rulings with the IRS, where people who made mistakes, they get dinged for it. Either they owed a bunch of taxes, they had penalties to pay, fines, and they're trying to get it removed. Sometimes they get some grace from the IRS. Other times,
not so much.
They don't get any grace at all.
Yeah.
And I would say that's probably the norm, is they don't get any help from the IRS.
Right. And the IRS is one monkey you do not want on your back. You do not want them.
Correct.
You don't want to hear the knock at the door and it's the IRS. That's for sure. And so just to clarify for our listeners out there, I mean, traditional IRAs and 401ks, they're quote unquote tax advantaged retirement accounts.
Right.
That they say tax advantage because you get a deduction on them the year you put the money in. Correct. You don't have to pay tax on that money that year, so it doesn't count as taxable income, but it grows tax deferred. So when you take it out, you have to pay full taxes on the full amount. Is that right?
That's exactly right. Yeah.
And that's the problem. So people, I think, forget about that. And I always say, and I've said it on the show before when we've talked about this, people don't understand. I remember having this very conversation with a friend of mine. Said, I've got $100,000 in my 401k or in my IRA. I think it was an actual traditional IRA. And I said, he said, so I'm going to use that. And I go, well, really, you only have probably 75,000 in there. And he goes, no, I have 100,000. And I go, but it's a joint account. And he goes, no, it's not. That's my money. And I go, nope. It's a joint account with Uncle Sam. And Uncle Sam is going to take 20-30% of that.
Yep. That's exactly right. And
Or
not
more.
not only that, but if your friend was younger and he wanted to take that $100,000 out, if he's below 59 and a half, that magical age,
and he was,
he's going to pay an extra 10% penalty on top of your ordinary income taxes. So, and that's definitely something that a lot of people end up, they mess things up because they had a financial need, and of course, where are they going to go? I mean, I've got this money sitting here, let's pull from it. And maybe they knew about the 10% penalty, but a lot of people don't even realize that it's there. And if they're not working with a trusted financial advisor who's going to tell them these things, then they can end up running into those pitfalls and having more owed because of that 10% penalty.
A lot of people think they're in a low tax bracket. Let's say you know that you're only in the 12% tax bracket, right? And you're like your situation here, you're under 59 and a half, and you go to take some funds out. Well, whoops, you're now paying literally 25%. I mean, just right there, right? 12% plus a 10% penalty is 22%. I mean, it's basically a quarter of those funds that you supposedly took out goes to the IRS.
And that's only if the funds you don't, and if you take enough funds out, it could bump you into a higher tax bracket. So you're going to pay, you could pay the full 25-30% on it, right?
Right. Sure. You go from 12% to 22%, plus then tack on that 10% penalty. You just went from 22 to 32% as far as how much goes to the IRS. So it really is something you have to pay attention to. And really, Tony, it's just simple math. You got to sit down and add up all of your income. What do you have for income for the year? And then add those withdrawals on top of it.
Yeah. You have to look at your taxable income. You have to look at the standard deduction. You have to look at where you're going to be. How am I over 59 and a half? Am I not? And really that money for anybody under 59 and a half, what I told my friend is, that money's for retirement. I don't, my money doesn't exist. Like all the money that's in my 401k and IRA, that I don't view that as my money. that's future Tony's
Same.
money. That's a different person.
Right.
So it's not my money to spend. I don't have that money. That money's untouchable to me. And if I look at it, if I have that mindset where I can't even go there, I've built this brick wall between me and that money.
Right.
And the only person with a ladder is retired Tony. He can climb over there and start accessing that money.
There you go.
I mean, I think for me, I have to do that. It's just what
Mhm.
I have to play, human nature
Mhm.
and behavioral trends and issues. This is human nature. I think that's a good thing for people to do is wall
Mhm.
that money off, separate it. That's where you guys come in. People can work with you or a trusted financial professional, and they can manage the money and worry about it. And you don't think about that money. That's not your money. That's not for now.
Right.
Right.
Right. And Tony, that mindset is how
It's-
your quote unquote broke people can retire well. Is because maybe they're broke because they don't have that money is set aside. It's
Right.
for their future selves. And so
Right.
they're not going to use it for right now. So maybe they're not going to go on that extra vacation because that money is slated for something else.
As you were talking there, one of the things I thought of, and it's not in our bullet points for the show today, but a lot of people go and take a loan from those 401k funds and talk about a potential disaster, because if you leave that company and go to move those funds, now it's considered a distribution.
Taxable distribution.
A fully taxable distribution. And if you're under 59.5, that's another ouch. And it's usually catches people very much by surprise.
Oof.
So I highly recommend, if you have another way of getting some funds, that you use it and don't use your 401k as a loan.
I have exactly one client that I saw the company allowed him to continue repaying that loan after he left the company.
Right. Most don't.
And I would say over 99% of cases, that is not the case.
Right.
Yeah. I've never seen that happen, but it is interesting that he had a situation where they allowed it, but typically
Right.
almost no companies would do that. So
No.
yeah, you have to repay it, and it becomes or you have to, it becomes a distribution.
Right.
You can't repay it at that point. You keep it, but you pay taxes and the penalty. If you're under 59.5, you pay the penalty. And at any age, you pay the taxes when you pull it out and when it becomes a distribution. Yeah.
Right.
That's exactly right.
Yep.
Now, one thing a lot of people look at when they go to take money from a 401k compared to an IRA is when you take a distribution from the 401k, usually they're going to withhold 20% taxes.
Right.
Okay. That's pretty much just a standard.
Yeah.
And it's just on federal taxes, and they don't withhold for state. Right. Now, one of the advantages of an IRA, and we've talked about this before, is that you can take a withdrawal from the IRA and customize it to your individual tax situation. So maybe you don't need 20% federal. Maybe you need 12% federal, and you need, like here in Missouri, 4.5% state, and you can do that. Or maybe you're in a situation where we need to withhold 24% federal and then the 4.5% state. You can customize it in your IRA, whereas the 401k, you cannot.
That's right. Yeah.
Interesting. Well, and I think that's really important to understand these things. So, I think another problem though with IRAs is when to withdraw. It's not it's not necessarily always about the amount you have in there. It's when you plan on accessing it. That can be an issue too, right?
Well, it can. Not only can it be a problem if you try withdrawing too early, but sometimes even waiting too long to start taking withdrawals can end up hurting you in the long run. And when you look at somebody's taxable situation, when you're taking money from these pre-tax accounts, that's adding to your taxable income for the year. It can affect the taxability of your Social Security. Right. So if you're into retirement, you're on Social Security, and let's say you're age 73 and you have to start taking your required minimum distribution, and you have a high IRA balance, that required minimum distribution could be pretty high, and it could end up knocking you into the next tax bracket, and it can impact the taxability of your Social Security. You could go from 0% of your Social Security being subject to taxes to 85% of it being subject to taxes just because your RMD is so high. And so by not planning, you ended up hurting yourself in the long run and costing yourself more in taxes. And not only that, let's tack another thing on top of that. We talked before on the show, Tony, about Irma, and we said that's not your great aunt. This is
Aunt Irma,
Right.
the crabby aunt. Yeah,
that's right.
the mean one.
Yeah, this is an extra fee for having too much income in retirement, and it's affecting your Part B and your Part D premiums for Medicare. And so, if your income is over a certain threshold, that can really start dinging those premiums, and it can add up quick. And so, by not taking withdrawals early enough from your IRA, now you have a higher RMD in your later years, and it ends up impacting your Social Security, your Medicare premiums, and you're paying extra taxes because you're in a higher tax bracket because your income is too high. Ouch.
Yeah. Ouch is right. And now I know we've talked a lot in the past. We've done shows on Roth conversions.
Right.
And you guys have, I know you're big proponents of that when it makes sense. What's the age? Is one way to address some of the issues you've been talking about when it comes to your traditional IRA and paying taxes later and RMDs? One solution to maybe at least avoid or minimize those RMDs would be to do a Roth conversion. And you can do those before age 59 and a half without the penalty, right?
Correct.
If you have, let's say you have an IRA, what's the window for, what's a good age window? I mean, you can do it at any time, but there's probably better and worse times to do a Roth conversion, right?
Yeah, there are. And a lot of it depends on your current situation.
Yeah, it does.
Sure.
And for instance, when we're sitting down and talking to someone, look at their income. Do they have, is it a farmer who's going to have an equipment purchase this year? Well, it's a great time to convert some funds over to Roth because that purchase will be a deduction against those taxes. But when it comes to conversions, a big advantage to getting them done a little bit earlier than a lot of people think is because of Irma. Right. So because Irma has a 2-year look back, right? So it looks at so if I'm getting ready to turn 65, it looks at, and it looks at what I did 2 years prior. Right. So if I can get Roth conversions done before I turn age 63, that's really awesome because now those funds, Irma won't have any effect on any of that anymore. So now it just looks at my current income, but hey, I may now have Roth income and not have to worry about it at all.
Because when you do take that out of the Roth for a distribution to use to live on or for whatever, then it's not taxable, the stuff you've converted to a Roth.
Correct.
The money in there, it's growing tax-free. All the growth is tax-free. It's not tax-deferred. It's tax-free once it's in a Roth. You have to pay taxes to get it in there, but that's why timing matters so much. Right. You might be in a better position to do that like between 55 and 63, for a lot of people. And I think that's a really good point. But again, like you said, it depends on your situation.
Yeah. Right. Honestly, everything with finances is very situational.
It's
it's unique to your set of particulars, really.
Yeah.
And the other thing that Roth benefits you with, those RMDs. There are no RMDs on your Roth IRAs.
Right. Yes.
So
that's
you don't have to worry about that. You don't have to worry about impacting Irma once you have to start taking required minimums because there aren't any. You don't have to worry about it impacting the taxability of your Social Security because it doesn't get figured into your modified adjusted gross income.
Right.
So it doesn't increase that provisional income that would increase your taxes on Social Security. So it's absolutely huge. And then you're not going to have to worry about getting thrown into a higher tax bracket either. So honestly, a lot of the pitfalls we're talking about here, there is a solve to them. You do have to bite the bullet and pay some taxes because we've got pre-tax accounts. You can't get out of it without paying some taxes.
Right. You're going to have to pay the taxes at some point on that money. You can't get out of that. So do you want to pay it now when the amount's lower, or do you want to wait? You're either going to pay it now or later. And the chance of taxes going up later are probably pretty good. So it might make sense then, right? Is what you're saying.
Yeah, absolutely.
Yeah. And then another question I have is we're talking about withdrawals out of these traditional accounts, IRAs and 401ks. What about another way to get around that tax picture and be more tax efficient? The first way you talked about is a Roth conversion. There's another way, though, right, to move money out of that account or deal with those RMDs without being taxed, right? And that is QCDs, or if you want to give to charity or your church. How does that work?
So at 70 and a half, you can now take what would normally have been your RMD, and you can, or any amount up to, I believe it's $100,000, and go ahead and gift that to your church, your charity. And the nice thing is that's not added to your taxable income, and the charity or your church doesn't pay taxes on those funds either. So if you're charitably minded, it's a great way to solve that.
That's awesome. I like that because I saw my parents make that mistake. They were both over 70 and a half when that was the age, and they had an IRA. They had to take RMDs, but yet they were just cutting a check out of their checking account to the church. I think they did it twice a year, and they were giving, 10% of their income they were tithing to the church on a regular basis. And they could have made that a lot better, and even helped the church more if they would have wanted to, because they could have given more because they would have not had to pay taxes. So they could have given the full amount they were giving if they counted in those taxes, because you don't have to pay taxes if they would have just had a qualified charitable distribution made from that IRA to the church, is what you're saying.
Yeah, and I run into a lot of people that don't know about it.
Yeah.
And you're right. They're already giving to the charity or to the church, and they just don't realize that there's a better way to do it.
Yeah, they're donating to a school or a county museum, or they're donating to a charity, a fundraiser, a nonprofit, and they don't realize that they could be doing it and donating tax-free dollars, and then that way they've never paid taxes on that money, right?
Right.
Exactly.
Any way we can optimize how we distribute funds from those pre-tax accounts is beneficial. And like Josh said, we've had a number of people that were already giving to a charity, and just telling them, hey, instead of giving it just from your checking account, give it from your IRA. Neither of you pay taxes on it then.
That's huge. Yeah, I think that's a big one that a lot of people don't realize, and especially people who are doing a lot of charitable giving, or they're like, I don't need the money in my IRA to live on. Some people are in that situation. And then there are things they can do with that. But they also want to be careful, because if they say, well, I want that, I'm just leaving all that money. I've got $1 million in an IRA. I'm going to leave it to my children. It's a traditional IRA. What are they doing? They're leaving a ticking tax time bomb, as your buddy Ed Slott would say, to their loved ones, right?
Yes.
Yeah, that's exactly right. Yeah, those IRAs, they're infected with taxes.
Yeah.
So,
yeah.
And somebody's going to pay them.
Yeah, somebody is going to pay them. So I know that you briefly mentioned it, Josh, but another aspect to withdrawals from a traditional IRA, they do count as taxable income. So they could actually make some of your Social Security taxable. Up to 85% of your Social Security benefit could be subject to whatever tax bracket that withdrawal puts you in. Is that right? Am I right in the way I said that?
You are. Yep. So it's taxability of your Social Security is based on something called provisional income. Provisional income is a calculation that's made up of your adjusted gross income plus half of your Social Security. And if it's over a certain amount, for single filers, once your combined income exceeds $25,000, up to 50% of your benefits are taxable. And above 34,000, then it's up to 85% are subject to your tax bracket. It's not an 85% tax. I've had people balk at that number, like, what? No, it's subject to your tax bracket. So
yeah, at least 15% of Social Security checks are not taxable, but the other 85 can be. But people say, no, I heard the one big beautiful bill made it so I wouldn't have to pay tax on Social Security anymore. Well,
Nope.
that's not for everyone, but for certain people who qualify, they just increase that standard deduction with a super deduction of
Correct.
$6,000 per person. And by doing that, the majority of Americans, or a lot of Americans out there, way more than 50%, even those who would have been paying tax on Social Security, that'll drop them below that point. That's a huge standard deduction. Another, if it's a couple, it's another $12,000 they can write right off the top of their taxes. So that'll help. But if you're still taking $100,000 out of an IRA that year, a traditional IRA, the $12,000 might not keep you out of a higher tax bracket.
Exactly.
No, you're still going to be in a higher tax bracket, but you will still be having, a lot less of your funds subject to taxes.
Yes.
We'll take it.
Yeah, we'll take it, because I'm not trying to poo-poo what they did, but they I think a lot of politicians said, no more tax on Social Security. Well, that's not true. Social Security is taxable up to 85%. The tax rules regarding Social Security did not change at all. Correct. But they've really increased the standard deduction, the senior deduction, and now the super deduction. And we did a show on it. I think it adds up to about $45,000 for a couple, for a married couple who is over 65 in a standard deduction. If they qualify.
That's significant.
Yeah, that's huge. I mean, my parents don't have they hardly have any income anymore, and so they're going to get that $45,000 standard deduction. They didn't pay taxes for last year because of it.
Right.
They paid
we have
zero.
A lot of clients that ended up getting money back for the first time in a few years.
Oh, I bet. I bet. Now, if you have a lot of income and money in retirement, or you're taking out a lot that year, doing these withdrawals we told you about, and ways to try to avoid getting in that position, like Ed Slott says, they might still pay taxes on Social Security, right? Yeah,
that's definitely right. But for those that have a high income, you're still going to pay some taxes.
Oh yeah,
but it will be less because of the one big beautiful bill. But you know what? We'll take it. We'll take that deduction. It's going to help. And like you said, it helped the majority of Americans pay less.
Well, it lasts. Yeah, it's temporary, at least. I mean, they say this is permanent, this is temporary. When it comes to taxes, nothing's permanent. That's for sure. Well, hey, we're out of time. But before we go, let our listeners know how they can get a hold of you to come up with a plan, a spending plan in retirement, a withdrawal plan, so they don't end up with a ticking tax time bomb.
Absolutely. Well, listeners, give us a call. Our number is 417-641-3497, and visit our website at LaTourAsset.com.
All right, and that does it for today's episode of LaTour Retirement Talk with our hosts Jim Margraf and Josh LaTour.